Africa has an abundance of mineral resources, and yet many African economies have been unable to translate this into great sustainable development and transformation, in part because they're so reliant on rents and on exporting the raw materials unprocessed. So how can we shift this? How can we build integrated minerals industries that will drive local industrialization and actually meet the national and regional needs of the people? With us on the program today is Dr. Paul Jourdan, the former president of the Council for Mining Technology in South Africa, to discuss these and other questions related to how we can build an integrated minerals sector in African countries. We hope you enjoy the program. Dr. Paul Jourdan, welcome to the program.
Thank you.
So just to get us started and to introduce the audience to this concept, what do we mean by an integrated minerals industry?
I think what's meant, well, the meaning I take, is minerals were always enclave development. In the interior, railway line to the coast, minerals out to Europe, and more recently, other countries like China and so on. And when we talk about integrate, it's integrating those minerals into our development, into Africa's development, not just sending them off. So trying to use our mineral endowment to develop ourselves, to supply key feedstocks into our economies, such as steel, polymers into manufacturing, aluminium and copper into our power system, transmission and wiring, and fertilizers into agriculture, etc. So you're integrating those minerals into your economy rather than them just being integrated into global value chains.
And I suppose the question then becomes slightly obvious, but why would this be so important now? Surely, those industries exist. Why don't we just maximize the revenue and go elsewhere with the profit that we get from that?
Because if you want to develop, you need those. We're assuming you want to industrialize, to create employment. Now, your fastest job creator globally, we know, is manufacturing, like China did, where they hauled 500 million people out of poverty. And there doesn't seem to be another paradigm in the last 200 years. Is we've got to get into manufacturing. To get into manufacturing industrialization, clearly, we need to start using our minerals for our development. It's been around for years. There was a book in Tanzania on resource-based development in Tanzania written in the 70s. I had a copy that had all the, Tanzania has just about all of the minerals necessary for development. And in the days of Ujama, that was the idea, kind of locally based development. So it's been around for a long time until we got the Washington Consensus, and we were at gunpoint virtually because of debt, forced into the structural adjustment programs and forced to open up. And then we moved back. So in some ways, what was being pushed by the World Bank, and I remember saying this at a conference in the early 90s, was a return to the Governor General. So we went through a phase of trying to use our resource to develop. We failed. And then we were forced back into just becoming suppliers to the rich countries.
I'll come back to those kind of questions later on, but just to again stick to covering the basics, what are the kind of common characteristics of a minerals industry? Like what does that look like?
Well, it's a commodity. So commodities have volatile prices. They have cycles, super cycles, slumps. So they are cyclical, variable. And in the very long term, decline in terms of trade. So if you look at the long term and you take a ton of copper and what manufacturers it could buy, it's always getting less. So it's a bit of a mug's game. That's the Prebisch and Singer thesis. Though during the boom we had real price increases, and this new level is still positive. So look into the future, that minerals might maintain their value. The other thing about minerals is the contestation around the resource rents. When you manufacture, there are no resource rents. There's no rents embodied in the item. When you make this glass, for instance, you're buying all the different, the silica, the soda ash, etc., and you're competing on a level playing field. There's no freebie. But with minerals, you could have a high-grade deposit against the world average deposit, and that's a differential rent, a resource rent. So because of those large rents, there's a lot of contestation. In hydrocarbon, those rents are generally captured, where they've got taxes around 80%.
So you mentioned hydrocarbons being different from minerals, and we're used to hearing of the extractive sector. What are some of the differences between, say, minerals and other parts of what we broadly call the extractive sector?
Yeah, okay, you mean what the Nigerians call solid minerals or hard rock minerals or whatever, because hydrocarbons are minerals as well. Well, firstly, in hydrocarbons, globally, there's generally a much better deal. This started way back, in fact, with Libya and Gaddafi in the 60s, of striking much better deals where the resource rents were captured by the country that owned the hydrocarbons. Secondly, of course, hydrocarbons has an oligopoly, has an OPEC. So the price is kind of managed. While other minerals, other than diamonds, which also has a monopoly, other minerals are pure supply demand, while, as you're aware, hydrocarbons aren't. The second is the complexity of mining is much greater than drilling a hole and the mineral comes out in liquid form on its own accord, or it's pumped out or whatever. So it's a much more labor-intensive process getting underground and digging minerals out. Yeah, the price volatility is a lot higher for hard rock minerals.
And in terms of then building, say, an integrated industry around them, what are the challenges there similar or?
They're very similar. Your challenges of building industries are very much due to scale economies. Hydrocarbons have become ridiculous. If you want a cost-effective refinery, which is the next step, right, to produce all of your liquid fuels and your polymers, etc., it's now a minimum of around 200,000 barrels a day, while only 30 years ago you could put in a small refinery like you guys had in Dar es Salaam. You had a very small, it doesn't run anymore, I think it was Egypt, a small refinery. I think it was only 20,000 barrels a day, but it's now completely, you can import product way cheaper than that refinery. And scale economies have really hit both. If you're going into other mineral processing, like pyrometallurgy, where your furnaces now are very big, because these are process technologies, and the bigger, the lower your unit cost. So it means for Africa coming in now, we have a much bigger barrier. The Europeans could have very small plants 50, 100 years ago, they were economic. Today, you can't put them in. And that's why we need to move towards regional integration, because then we have the demand and markets for cost-effective plants. Only with the agglomeration of, say, SADC in Southern Africa or ECOWAS in West Africa, do we have the demand to justify the scale economies of today.
So you've touched here on both kind of the opportunity of growing the market and regional integration, but also then the challenges that present. And I want to kind of split these two apart, and if we can just focus first on the challenges of building an integrated minerals industry. So you mentioned one is scale. You know, what are some of the other kind of prerequisites for success?
Well, if we're looking at the Africa mining vision, we're looking at the downstream, going further down and adding value until that mineral is in a form to be used by our economy. Our economy, like if you're a cable manufacturer, so the copper must be in the form of CCR, continuous cast rod. So you've got to get to that point. Then it's upstream or backward linkages into all the inputs. And there's an advantage, because it doesn't matter whether you're mining gold or copper, the explosives detonate, the inputs are the same. There it's more about the type of mining, not the mineral. So open cast or underground, hard rock or soft rock. The minerals could be the same. And that's a big opportunity we have for industrialization. The main constraint there is that these are capital goods, the equipment, the machinery, the plant, and your main constraint there is skills, is that you need to concentrate on STEM, that's science, technology, engineering, mathematics skills.
And what does failure to make an integrated minerals industry look like, to go the other way? Because it seems now this is
what we have. It looks like what we have.
So just more of the same.
Yes, that we have very volatile economies. They go up and down with boom and bust, as we've just had. We, go into debt, or then there's a boom, and there's money everywhere, and the bureaucracy expands. And then when the prices drop, you can't fire everyone, because that's not very elastic, and then you go into debt. But this is what we've had since independence in most African countries. So that's what it looks like, more of the same.
It's a bit of a gloomy, we shouldn't be laughing, it's a bit of a gloomy picture, but if that's the case, is there an argument to be made for maybe just holding off on touching the mineral sector and maybe investing elsewhere? Agriculture is one area people talk about, but other drivers of the economy, would be better off just leaving whatever we've got under the earth where it is for now?
There's a complex answer to that. One is, for key feedstocks, yes, I'd agree. We can't make those linkages for key feedstocks that we will later need for our own development. Maybe we should leave it in the ground. However, if our resources are enormous, then it really doesn't make a difference. You can export and you'll still have in the future. If there are minerals that we're not going to use, exotic minerals, say like tantalum, niobium, etc., that we will maybe use in 50 years' time, by which time cell phone technology would have changed or cell phones won't even exist, right? Those as well you can go ahead with, but you shouldn't mine without being able to make the linkages. So you need local content to make the backward linkages. So that must be built into the license. If we rewind this conversation, the premise is that the minerals in the ground belong to all of the people, and the government governs them on behalf of the people. If that's the principle of it, then we shouldn't mine if we can't make the linkages, because then we're only getting less than half of the benefit. So we need to make those upstream, side stream linkages. Now, if they belong to the people, and now you're giving someone a lease to mine the people's property, the minerals in the ground, you need very tight conditions to make the linkages, because they won't happen through market forces. They've got to be built in, like your local content laws, your value addition, then your side streaming to knowledge, where you've got to say, like South Africa does, that 5% of payroll must be spent on training. And that is law. That's a condition of the lease. Now, unlike another lease where you may lease a building, you get the asset back at the end. Yeah. But with mining, you get a hole in the ground at the end. Therefore, your conditions need to be more stringent, because they're not giving back at the end an improved asset, like a concession for a road, a build, operate, transfer. At the end of that, let's say it's a 20-year concession, you get a highway back, where before you had a dirt track. With mining, no. You start with, say, $1 billion in the ground, and at the end you got a hole in the ground.
Figure out what to do in between.
Yes. So therefore, you need to optimize. There's even more, a greater sense of urgency to optimize the developmental impact of extraction. So I'm a bit of an extremist that I'd say don't mine if you can't make those linkages. If you're just going to mine using everything imported, some of the mines in Tanzania, they even import food, right? The mines, they import the whiskey for the expatriates, they import. So your net gain is small. All the equipment is imported, all the consumables are imported, right? Even services are imported, using foreign banks, for instance, foreign analytical services, etc. And then there's no value addition. They just send out doré, gold. What's really in it for Tanzania other than some short-term pennies?
But what about this fear that if the framework you've established to achieve all of that is so stringent that you can't then attract investors? Because this is usually the counter-argument. You know, we're going too
Absolutely.
far, we're asking too much. So in that sense, how do you find a balance which works for both the investor or the business community or whatever you want to call it, and for the people who actually own?
Clearly, if those conditions are unachievable, you're not going to get investors, right? And we always have a problem where we're trying to set one law, say, for local content for all mines. Some mines are rich. As I said, the resource rents can vary from zero in a marginal mine to extremely high. The resource rents are defined as the difference between a normal return on investment, now normal in Tanzania is most probably 20%, and what they get in, maybe 100%, so that 80% is resource rents. Now, a mine like that, you can load a lot of conditions and it's still very attractive. Just like oil, they take up to 80%. But that 20%, because the resource rents are so high, that 20% is so good, they still invest. So like Norway, I think it's about 75%, so they're only getting 25%. But 25% is still a damn good return on investment. And then you can go all the way to the other extreme to a marginal deposit where it really can't handle any conditions. So how do you set the rules for mining? It's extremely difficult. And what we tend to do, because we always want the marginal, we set far too low.
Mm-hmm. So we're setting it against
We're setting it against the worst deposit we want to get investment in, but maybe that is exactly the deposit that you say, okay, we leave for another day. For when the price increases or there's new technological innovation that makes that non-marginal, makes it more viable or whatever. The second is that we don't do, is that we do not auction our assets. If you want price discovery, now every deposit's different. And the best way to get the linkages is to build them into the auction criteria, to take them out on concession. So you say you will be judged on the tax rate, bid it up, this is the minimum. Because that's really, what's the value to the state from a fiscal point of view is the total, the sum of all, or the NPV, the net present value of all the revenue streams over the life. And how do you determine that? That's the tax rate. Then they can bid up local content, whatever they're comfortable with. They can then, and then you get in a market response that's customized for that deposit, because deposits are so variable. It's not like making shoes. It's nearly the same in every country. You've got the same cost. You've got labor, you've got leather, you've got the rubber soles. So you're competing very much in the same realm with other shoemakers, right? But not minerals. You may have a very high-grade deposit, or it's a very amenable to processing, or it's very close to the coast. There's a massive variation. And it doesn't go by type of mineral. Gold can go from marginal to fantastic. Coal can go from marginal to fantastic. It's all over the place. So if you want the pure method of determining how much you can load, put it to the market. So if I go back, 30 odd years, in the late 80s, when your minister was Al-Nur Kasum, we did a kind of a brochure of prospects to attract investors. And then I look at all the investment. There's nothing discovered. They were all in that brochure. All your new mines. So the private sector didn't discover anything. They just went through your archives and your old colonial geological survey, and they went to old workings. Those should have been put out to tender. Even with that little information that was known, it was enough for those JRCs who then, when you changed your mining law and opened up, what happened is they came in for free. And what was the regime? It was the lowest common denominator. It was the regime set for the marginal deposit, and many of these were rich. And then you spent, since then, trying to tighten it up. But to tighten up after the fact, the private sector kicks back. But if they come in and that's transparent from the beginning, there's never a problem because those are the rules. So when you try and change the rules, you get kickback, and also their home countries and the Bretton Woods all tell you, no, you can't do this, you've got to have stability, etc. So the ultimately best way is to reinforce your geological survey so that you know what assets you do. So do systematic exploration. It's become cheaper because of various forms of remote sensing and aerial survey, aerial geophysics, etc. Take the anomalies, this is what's done in Finland, zoom in on the anomalies, then the state does further work, possibly with the private sector, contracting, to build it ready for auction. And that would be the ideal way to handle minerals, not this open up, come in and get it for free, make a fortune, and we can't change the rules when we suddenly discover, oops, that was a really high return deposit. The best always get price discovery. Get the private sector itself to bid it up.
First competing against itself.
Yes, and then you will get what they're comfortable with, and they can't complain. This is what they bid. Yeah, we bid that you're going to have 60% local contact. We feel that's doable. We bid that we're going to go down, we're going to put in a gold refinery. It's doable. And then if they don't, because it's a lease, they break in the lease. And then you can take the deposit back and re-auction it.
So just to start wrapping up the interview, as you said, this is the state of affairs now is quite dire in your opinion. Yeah. Are you optimistic that we can turn this around on the continent? Is this something that you think is doable, in the near future, in the medium term?
Yes, we've had a big change. Things are different now. After colonialism, the fixation was on the fiscal. How do we get money? How do we get cash out of this? Then, for a long time, then we started seeing that there are a lot of other advantages to mining, a lot of other linkages that could catalyze other development, and how mining could catalyze other sectors, for instance, agriculture. Most of southern Africa, we're just depleting nutrients from the soil, NPK, nitrogen, phosphate, potassium. We need to replenish. The yields would go up. We need a green revolution for Africa like happened in Asia. So minerals could play a key role, pivotal role in getting cheap fertilizers to our people who are mainly peasant farmers. So with the Africa mining vision, for the first time we've unpacked it. And we now have a kind of a blueprint that we didn't have before. Before, all the advice was around fiscal.
Maximize your revenue.
Forgetting all the purchases. So for instance, SADC is double Europe as a market for mining inputs. That's enormous. When we try and, say, make glasses, we may be 1% of the European market, or motor vehicles. But in this niche of mining, we're way bigger than Europe, yet we're dominated by European companies that don't have a home market. Why are we not developing those? We have the market, we have intelligent people, we have the minerals. So we can do it. But the problem is trying to do it in one country. So petty nationalism. And we've seen in this conference, constantly the strategies being put forward are like for islands. But we're not islands. And these borders are just lunacy. They're a bunch of Europeans on bad drugs in Berlin in 1880s. They're just lines on a map, cutting right through ancient African nations, through cultures. They're senseless, and yet we hang on to them. At the same time, elements that benefit pour gasoline on it. This whole Anglophony, Francophony, and all kinds of phonies. That there are European countries who encourage that. That's called divide and rule. So not only European countries, even we have in our countries this petty nationalism. Often our own business sector are pitting us against the neighbor. Like buy local, don't buy from Kenya. There was a reaction in Tanzania of that sort. I would agree with the first Prime Minister of this country, Ghana, that if we don't integrate at least at a regional level, I don't see us getting out of this trap. Even South Africa, that has a big market, is not big enough for real competition. In basic feedstocks like polymers, steel, we have monopolies because, so even the largest industrially we have to integrate. So it's basically we have to integrate or we'll wither. We'll just continue as these little island states of poverty.
Then just to close the interview, just if we could have your final thoughts, although you did kind of wrap it up quite nicely on, on building an integrated minerals industry. What's the one key thing you would really want, say, decision makers or in fact the stakeholders, the people who the minerals belong to? What's the one key thing they should really take away from this conversation?
This is a bit of a duck answer. The first is we need to domesticate the Africa mining vision. But that's not going to go, that's then the country mining vision, and that's the island state. So you can only go that far. The key thing that we need to do is to at least regionally integrate around the Africa mining vision. So don't go for complete regional integration of a common currency and a complete customs union. Why don't we concentrate on where we're going to get the best results fastest?
On value chains.
In the mineral sector. So if we concentrate on mining inputs, create a regional market, and mining feedstocks, mineral feedstocks, create a regional market, then we can start small like Europe did. They started with the European coal and steel agreement in the Schuman plan. I think it was 50-51. And only in 59 did they go Rome and integration. So let's start with a manageable subset where the advantages and the rewards are clear, are palpable. And then everyone can see, wow, working together we all benefit. And then go for the more complex integration of everything like the EU. But the one takeaway is let's integrate around the mining inputs and key feedstocks. Not the export minerals, the key feedstocks for our own development.
Well, on that note, thank you very much for coming on the program and hope to have you again sometime.
Pleasure.
Sure. Thank you.
Asante sana.